Hi, Frank and Steve here. Today we're going to talk about what's turning out to be a shockingly crazy start to the year. I was hoping we'd actually get a break after 2025.
No such luck.
Oh my gosh. So let's start, before we talk about what we are going to do or trying to do, let's talk about what we are definitely trying not to do, and that's really two things. Number one, the last thing we want to do is follow others that are following a playbook of what works yesterday. That today is true more than ever. Secondly, we do not want to predict, and that's hard to do. Rather, we believe the most productive and rational path forward through a period where the rate of change is accelerating is to observe, not predict. And if we can observe and try to understand whether changes, just how durable they appear to be, and then who's winning and who's losing. And if we can use that as the backdrop for decision making, we believe that improves the odds of our success than especially trying to predict second, third, and heaven forbid, fourth order effects. So with that, Steve, what do we observe? What are we seeing?
Here's what we're observing as we see it today. And I want to frame this: US politics, geopolitical, earnings, and then what that means for investment portfolios. So let's start with US politics. As of now, according to Polymarket, the Democrats are expected to win the House by about 78% odds. So what does that mean? I would argue that the Trump administration will do everything in their power to be more stimulative to try to juice the US economy. Part of that's already in place. So the OBBA bill, if you look at it, is actually much more stimulative to GDP in 26 and 27, ironically, right before the election.
That's the big tax bill that passed last year.
Exactly, the one big beautiful act, OBBA. So ironically, GDP goes up in 27, and then of course it's a GDP drag after the next election cycle, and not to go down a rabbit hole, but that's often why we have continued deficits going forward. Secondly, Trump and Powell are not best friends. They're not taking long walks on the beach together, and there's clear animosity. There's now subpoenas of the Federal Reserve and of Powell. This is all pressure, all implied pressure to try to get him to leave and effectively lower rates, which would be stimulative to the economy. That said, inflation has been coming down. As a reminder, inflation is the rate of change in price over last year. It doesn't mean prices are coming down. The rate of change of prices going up is less. Biggest contributing factors there are the price of owner's equivalent rent, which is housing, and we're starting to see a slowing of increases of prices, giving the Fed, if they're looking at current data, the cover to lower rates further. The Fed, as of this point, has cut rates by 175 basis points, or 1.75%. Moreover, with the incentives of 100% depreciation to build manufacturing in the US, incentives from people spending or companies spending just tremendous amounts of capital on artificial intelligence, data centers, Taiwan Semi spending well over $100 billion on semiconductor fabs, Micron announcing a $100 billion memory facility in Syracuse, New York, defense contractors in Ohio, and down and down and down the list, auto manufacturers. The amount of capex going up and reshoring, we are observing the announcements, and we're observing shovels getting in the ground, and capital expenditure in the US is going up. Note that GDP is looking strong into the end of Q4 of 2025, and at least for the moment, looks pretty strong going into 2026.
Which is so different than what everybody expected, certainly us back several quarters ago with the tariff shock. GDP is actually coming in strong, and I think that's the big prediction. Sorry, that's the big observation, is the underlying fundamentals of the economy are strong.
100%. Now, the factors of the future are not going to be the factors of the past. AI and automation go hand in hand. We are seeing and observing robotics and automation, which is the precursor to robotics, expand in factories around the world. China has dark factories. You have the CEO of Ford coming back saying that we are behind in manufacturing tech, where there's, in some cases, no humans making some of these vehicles or parts of the supply chain of some of these vehicles. We're seeing Hyundai actually put robots in their factories in the United States. We're observing Airbus use robotics in some of the aerospace defense supply chain. This continues. So robots aren't the future, they're today. It continues to grow as we go forward as far as adding manufacturing. That doesn't mean there won't be humans involved in some of these plants. There will be. It'll be construction, it'll be in automation, but a plant may have 50 people, not 5,000 going forward. Continued theme. All of this reshoring or lack of reliance on Southeast Asia for manufacturing means more electricity demand, whether it's building factories here or in Mexico or in Western Europe, or powering AI data centers. The amount of electricity continues to go up and to the right. We do not think, at least in the near term for the next couple of years, anything stops that train. So that is a theme that we continue to observe. Trump in Davos said, we are going heavy into nuclear. Brought a smile to our faces for those of you who know our positions on the nuclear supply chain. We still believe there's not enough uranium out there to power all of the announcements on a go-forward basis. This is a global phenomenon, and energy is life. Energy allows for the progress of everything that we, Western Europe, and everybody else wants to do. And if we are power constrained, which is what Mark Andreessen or Elon Musk or others suggest that we are, energy is the cornerstone. Importantly, and this is, if you remember one thing from this talk, this is it. We are observing that the S&P 493, as we like to call it, or mid caps, or small caps.
All right, this is the S&P 500 minus the Mag 7.
Minus the Mag 7.
For those of you who may not know.
So we can debate whether or not the investment in artificial intelligence will have an economic return. I think that's a healthy debate. I'm sure that some companies or some of these AI investments will wind up being losers or not have an economic return. That does not mean that the use of artificial intelligence in different forms and factors is not useful going forward. Same thing with the internet. We created amazing companies, but pets.com went bankrupt. So what we are observing is really fascinating. The earnings estimates coming from Wall Street for the S&P equal weight, the Russell 2000, mid-cap stocks are accelerating upwards. We are observing productivity improvements happening in company by company, in industry by industry. The big banks just reported last week. They are reducing employees, they're growing revenue. Microsoft has added $80 billion in revenue and reduced headcount. So whatever we think about AI, we are, at least in the near term, observing productivity increases, which means earnings increases. The biggest driver of stocks on a global basis, year in, year out, we can talk about who we like in office, what we think about GDP, it's earnings growth per share for companies. If earnings are going up, stocks generally go up and follow. And that is the biggest thing that we're observing today. Could there be hiccups in the road? Of course there can. But for the moment, AI is actually showing an increase in earnings in non-spenders or non-hyperscalers across the globe. This is also an international phenomenon, and importantly, we have to talk about both the positives and the risks. At Davos recently, you have Mark Carney seeking to reset the relationship with China and build trade ties. This is Canada that shares a 5,500-mile border with the United States, whose economy is 75% tied to the US, talking about aligning with another major superpower in the world. With the Greenland spat, we are seeing Swedish pension funds, a Danish pension fund, saying that they want to sell their US treasuries, that the US is not a reliable partner on a go-forward basis. Importantly, foreigners own about 20% of the United States stock market in value. They also own about 30% of treasuries, also about 30% of corporate debt. If they repatriate, and we are seeing signs of that happening, international markets outperformed US markets in 2025. International markets, importantly, are still inexpensive to US markets as of today. If we see repatriation, whether it's Japan or Europe or Latin America, given what's going on in the world, as ties change, as economic incentives change, as trading partners change, as countries work for their own best interests, that might mean continued capital flow coming from the United States back home. And there is a long way to go from that standpoint.
And that's a double whammy.
Yeah.
It is both an increase in the valuation of international stocks, which, as you mentioned,
Yeah.
are cheap by history standards. Further, decreasing value of the dollar is an additional boost to the returns of international stocks.
And we see signs of this. So when we look at the price of gold and silver, for example, it really started, in our opinion, when Russia invaded Ukraine and the US, through the SWIFT system, effectively froze Russians' availability and access to US treasuries. When that happened, many countries picked their heads up and said, why should I own treasuries as a reserve asset if I may not be able to access it if I'm not necessarily best friends with the United States? And who knows who comes into favor and out of favor. But that's when we saw increase in central bank buying of gold. So we are seeing a diversification, slowly, at least for now, out of treasuries on a global basis.
This is a good segue quickly just on the power of and importance of long-term investing, because silver, I just have to laugh. Silver is a position we've been apologizing for years. How long have we had silver? When did we start put silver in the portfolio?
About 3-ish years.
So 3 years ago, and literally for the last 3 years until 6 months ago.
About a year.
In client reviews, I've had to apologize for, look, silver's kind of been the dog of the portfolio. The fundamentals are still there. We still believe in it. And then all of a sudden it works, and it works quickly. Gold, on the other hand, we've had as a core position since 2015 for clients. And there again, gold has had good and bad years, but this is the importance of having conviction in what you own and why you own it, and sticking with it with a long-term view.
Still positive on silver fundamentals. The price has gone to a point where we're questioning the sizing, just to be fair at this point. Which is actually an interesting segue on many assets, where if you look at US market cap weighted valuations, we're at 90%, the 90th percentile of historical valuation metrics. You have silver 5xing in 5 years, you have gold up 300%. Some things as a function of price were a lot, at least in our view, where we had more of a margin of safety. And it doesn't mean that these things cannot continue to go forward. And back to the point of earnings continue to likely go up, everything might be fine, but we're at a level or an altitude that warrants a little bit more caution and risk.
Well, and selectivity, and I think this is the key thing. Markets have a tendency to go where they can do the most harm. And if you look at, and that means how are most people positioned, and I think this paradigm of the 60-40, own a little bit of everything, market cap weighted, index, passive on everything, that has gone from kind of a fringe view 20, 30 years ago to a practically ubiquitous view in the institutional investor and financial advisory industry. And we question that. We do not want to be following that crowd, which in our view is extrapolating decades of historic returns and volatilities and correlations. We believe that is at best a naive extrapolation of the past, and potentially a dangerous extrapolation of the past. Once again, trying to have a forward-thinking framework, but importantly, not a forward predicting. It's observational. This is what we're observing. Mm-hmm. What else?
We were talking off camera about times being probably more dramatic on a geopolitical standpoint, really since any time post World War II. So we'll see what the future holds. We're looking forward to observe it. The knobby tires are on the dune buggy. So let's enjoy the ride.
Amen. Well said.